and earnings. Okay, we have different terms like bond, different modes on a bond, shares, equity shares, preferred shares. Okay, so today we are going to start our next topic, that is leverage. This is again from unit 3 of it. So leverage is like you have to change a tire. Okay, you have to change a tire of a car. So definitely you cannot hold a car for a long time by your own manual power or by your hand. So you take a step of some equipment which actually gives you some leverage, and then you can change your stepney or tire. This is what we mean by leverage. Okay, you take a help of something to ensure that you get some kind of leverage. Okay, so leverage is very important term in finance. Okay, there are different things which you have to understand about the leverage, that is financial leverage, operating leverage, and combined leverage. Okay, while you do your business, you will realize that by increasing 10% of sale, you can increase your profit by 50%. Okay, I will repeat, but you will see how it happens. By increasing 10% of your sale, you can increase your profit by 50%. Okay, for example, like before we start actually what we mean by financial, let's take example of our own life. Okay, suppose there is somebody who's making 50,000 a month. Okay, so what will be his or her saving? Maybe consider that 30,000 is a basic expense, basic in the sense room rent or EMI for flat, and basic provision store items or whatever they require. 30,000 is fixed expense, that is every month they have to incur 30,000 rupees. So their ultimate salary saving is 20%. Okay, so what is 20,000? Sorry, 20,000. What is 20,000? Is 40% of his salary. Okay, 40% of his salary is saving. Okay, but suppose he or she gets increment of 20%. Okay, suppose he or she gets increment of 20%. Okay, so now net salary will be 60,000 rupees. Okay, now increase in salary is just by 20%, but if you look at their saving part or their profit, like we can consider it's a profit. Whatever fixed cost, that is expenditure for us, or the fixed cost for us, and whatever we are saving considered as a profit. So initially, when that person had a salary of 50,000 rupees, his saving or his profit was 40%. Okay, but by increasing salary by 20%, his saving will now go to 60%, because with that 10,000 rupees, he is going to save now 30,000 rupees. So by increment in 20% of salary, is actually going to save 60%. Okay, by increasing 20% a salary, now he is going to save 60% of his salary. So this is what we call financial leverage. By making a small changes in our daily schedule, we can bring a lot of change in our own lifestyle. That is called leverage. Okay. Similarly, in financial leverage or operating leverage, we have a different terminologies. By making a small change in either a capital structure or in our sales revenue, we can bring a lot of profit or larger profit. That is called leverage. Okay, I hope you understand by this example. Again, I will revise that example. With 20% of increment in your salary, you can actually save 60% of your salary. This is what we call financial leverage. Okay, by increasing little more effects, you can actually save a lot of things. This is what we call leverage in life. Okay, you have that leverage by increasing some improvement in your input. You can have a better output or a lot of improvement in output. Okay, this is what we call leverage. So there are three kinds of leverages which we are going to study today: financial leverage, operating leverage, and combined leverage. Combined leverage is again nothing but a combination of financial leverage and operating leverage. So we will see in detail with one example what is financial leverage and what is operating leverage. We have seen example how it is useful in our daily life. Like I have said, maybe a similar task, like if you are working for say 8 hours a day, but you feel that that is a very busy schedule for you, because maybe somebody is waking up at 8 o'clock, so they have to make a rush to reach to office, and 10 o'clock they reach to office again, they come at 6 o'clock, and they start again traveling towards home and they come at 8 o'clock. Maybe by changing a little bit time, like right now USA, or there are few MNC companies, they have changed a time with the lockdown. Okay, they have changed a time with the lockdown. Like they are starting the see anyhow it is work from home. So instead of starting office at 10 o'clock, they are starting at 6 o'clock or 7 o'clock as early as possible. What change they have seen, like if you start office by 10 o'clock or 6 o'clock morning, okay, their office is over by 1 o'clock or 2 o'clock, okay, 8 hours a day. So their office will be over by 2 o'clock, but their employees will have full complete day to enjoy with their family. Okay, but if you go back with the same time, like say 10 to 6, okay, like any office is 10 o'clock, you will wake up at 8 or 8:30. So you will make a rush to get freshen up and you won't spend time with the family. So 10 o'clock you start your office, then it will go till 6 o'clock. By the 6 o'clock you may feel some sleepy or whatever, little lethargic because the time is little lethargic time. So you may take a coffee and some sleep snap, and by the time 8 o'clock, you again have your food and you go for a sleep. So you are getting maybe you are getting 1 or 2 hours with your family. But if you change our time, if you make little change in input, you are getting a very big output. It is leverage. Okay, I hope you now understood what do you mean by leverage. What is the utility of leverage in your own life? Okay, let us see what is financial and operating leverage to understand its utility in financial management. Okay, operating leverage. See, we have seen what is fixed cost and what is variable cost. Okay, I will revise again what is fixed cost and what is variable cost. Fixed cost is irrespective of your sell. You have to pay that charges. Like if you have started your store, it is a rented shop. So irrespective of whatever level of your business is, you have to pay rent for that business. You have to pay salary of employees. Okay, they will not, their salary is not dependent on how much sell you. Maybe incentive is dependent on their sell. That is variable cost, but their salary is fixed cost. So irrespective of their sell, you have to pay them salary and you have to pay them rent. That is fixed cost. Whereas variable cost is as your sell increase, your variable cost will also increase. Like if you do a business more than what is your target, you will get incentives. So more the business, more will the incentive. But that is variable to your like, incentives variable with respect to sales. So that is variable cost. Okay. So every business has a combination of variable cost and fixed cost. So what technique you have to apply to ensure a maximum EBIT? EBIT is earning before income and income tax. Okay. Earning before income tax. Okay. So or profit. Let's don't get confused with EBIT. Of in the general sense that is profit. Okay. By making a small changes in your fixed cost and variable cost, you can actually increase your profit by multiple times. Okay, we will see three examples here. Suppose this is a shop of a poha shop, or sorry, I don't know why I have this example of poha. This is considered as a restaurant. Okay, they sell idli. Okay, consider that they are selling idli. So there are three stores. One store or a same store having a three case study. Like there are three different quarters, and we are studying them for three different quarters. In first quarter, they sold 100 idlis. In second quarter, they sold 200 idlis. In third quarter, they sold 300 idlis. So 100 to 2000 is 100% growth, and 200 to 3000 is almost 50% growth. Okay, so there is some growth, quarter on quarter. So first quarter when they sold 1000 idli, their sales revenue, like there is a 10 rupees per idli, so they have sold 1000, so it is a 10,000 rupees. Here it is, suppose they have taken 100 rupees, so suppose 100 rupees each idli. Okay, so there is 1 lakh rupees. Second case, they have sold 2000 idlis in second quarter, so they make a revenue of 2 lakh rupees. And in third quarter, when they sold 3000 idlis, they made 3 lakh rupees. Okay, so this is very simple calculation. The more the sell, more will be the revenue. Okay, but what makes a difference is your variable cost and your fixed cost. Okay, obviously we have said that the fixed cost is going to save for all the variance. Like 50,000 is a fixed cost. Every time your cost is a 50,000 rupees, irrespective of your business. So your rent or the salary altogether was a 50,000 rupees for all three quarters. Okay. So in the last column you can see fixed cost or fixed cost. So fixed cost is 50, 50, 50,000 for all the three quarters. But you can see a difference in variable cost. Why variable cost? Because obviously if you are making 100 idli, you are no, you require more rava, or you require more equipment, more raw material. If you make 2000 idlis, you need to more raw material. If you go for 3000 idlis, obviously you need more raw material. So there are three different cases. In first case, the variable cost is per idli you are spending 50 rupees. Okay, let's go by that same example. So for 100 idli you need 50,000 rupees. For 200 idli you need a 1 lakh rupees. For 3,000 idlis you need 1 lakh 50,000 rupees. So in first year, with the 1,000 idli you have made a zero profit. You made a zero profit means that is a break even point. Okay, break even point means there is no profit, there is no loss. You have you have incurred a 50,000 rupees variable cost, and 50,000 is your fixed cost, but you are able to recover that. Okay, by selling 1,000 units you are able to recover that means there is a zero profit. Okay, with 1,000 you have your break even profit point, you have made a zero profit. This is an accepted situation. Okay, as long as you are not in loss, because going ahead you are going to make increase in the balance business, and obviously there will be increase in profit. But achieving break-even point is a first milestone. So in first case, we have achieved your break-even point. Okay. In second case, your increase in sell is 50%. Sorry, 100%. Okay, from 100 to you went to 200. So now your increment in sell is 100%, and your profit, if you look at from 0 to 50,000. Okay, there is no, you cannot measure in a percentage, but it is almost a 50,000%. Okay. In third case, you have increased your business by 50%. Okay, but your profit has increased by 100%. See, from 2,000 to 3,000, if you have increased your sell of idlis, that means you have increased your sell by 50%, 50. But if you look at your ultimate profit or EBIT, okay, it has gone up from 50,000 to 1 lakh. That is 100%. Okay, this is what we call operating leverage. Okay, so how can you improve your operating leverage? I hope you can make out now. If you look at the diagram, if you spend 3-4 minutes, you will be able to understand. Like this is considered, this is a balance sheet of some organization, and they came to you and they want to improve their profit. So what suggestion you can give them? Okay, first suggestion obviously to increase your sell. Okay, so try to increase 10% of your sell every time, because increase in 10% of sell may lead to increase in even larger profit, maybe 20 to 30% of your profit. Okay, as you go ahead, maybe that situation comes like when 10% of increase in profit, increase in sales may lead to 100% increase in profit. Okay, second thing, what you can suggest them, reduce your fixed cost. Okay, reduce your fixed cost. How can you reduce your fixed cost? Okay, suppose there is somebody who come to you for a suggestion, like any of your friend comes to you and they ask you suggestion. Yeah, I want to start my business, and to start my business I need some softwares. Suppose it is online education business. Okay, I need some software, animation, illustrator, or some of the other instruments, or some of the other softwares I need. So that's the cost of software is 10 lakh rupees. Okay, this is my initial fixed cost. Okay, without this I cannot start my business. So 10 lakh rupees is my initial investment. So he will ask for your solution and they will show you entire business. Definitely you can suggest them for initial few years. You can reduce your fixed cost. How can you reduce your fixed cost? Instead of investing 10 lakh rupees into buying a complete equipment, you can actually go for some institute, which, or you can go for a third party where you don't have to spend 10 lakh rupees. Rather, you can manage your expenses, in a 20-30,000 rupees per video or whatever you are doing. And remaining amount you can invest somewhere else so that you can generate a profit. In initial years when you don't have much work, because you can reduce a fixed cost in this. Okay, or maybe there can be many other ways. But first of all, you have to try, or you have to brainstorm yourself to ensure how can you reduce your fixed cost. Because anyhow variable cost, you won't have control on variable cost. You can control on variable cost too, but there is less scope for controlling variable cost. But you can work on reducing your operating cost or your fixed cost. The moment you are able to reduce your fixed cost by even 10%, your profit will ultimately reach grow by 50%, or maybe more than 10%, 20, 30%. Okay. This is what we mean by operating leverage. whenever you look at some balance sheet or whenever you look at a business opportunity, you have to ensure can you apply a logic of operating leverage. Operating leverage means reducing your fixed cost and increasing your sales. Okay. If you can spend, suppose there is some expense you have to incur, like you have to incur on advertisement. If you ensure that you spend X money on adverts, but that will lead to increase in sales, and ultimately you can calculate the the relationship between the amount of expense you are spending for advertisement. Second thing, how much sales you are increasing, and ultimately how much profit you are increasing. If by spending a 10%, by spending a 10% of advertisement money on advertisement, if your sale is increasing by 20% and ultimately profit is growing by 40%, then obviously it is a wise decision. So you have to calculate everything in three manner. How much I'm spending to increase my sales unit, how much sales is increasing, and ultimately what it is contributing towards my profit. This is what is utility of operating leverage. I hope you have understood the operating leverage. It is not a very difficult concept, but yes, once you understand its application, you can apply in your own life or in your own business or somebody else's business to see a miracle or to see the changes. If I have to tell you an example from my own life, like I have a jockey store, small jockey store, sports store. Okay, we have noticed that our fixed expenses around 50,000 rupees, but by increasing our sell by not 10-20%, which is very well manageable. Like even if we give one extra article to each customer, definitely our sale will grow by 20 to 30%. But if you do that, like there is a lesser effect leads. If every customer comes to buy some article, after buying those articles, if I promote some article which is we can say it's not need based item, but it is something which you buy as a what do you call that word? Okay, which you buy like it's not decided, but you can buy if you see that. Like you can consider handkerchief. Okay, if you are coming to buy undergarments or sport t-shirt and track pant, but ultimately there is a handkerchief and everybody needs handkerchief. If I consider that I'm getting a 40 to 50% 50 customer a day, if I able to sell even that handkerchief to 10% of customer, but imagine that selling of that handkerchief is 100% profitable. Why? Because that person is not came to buy that handkerchief, and whatever money I'm making, like my fixed cost and variable cost, is managed by selling undergarments or that sports pant and t-shirt. But whatever profit I'm getting by making selling this handkerchief is 100% profit. So increasing or converting that 10% customer or selling using that selling skill to sell handkerchief to those 10% of customer will lead to increase in 40 to 50% of my profit. So this is what we call operating leverage. So as a businessman, as an employee, you always have to work on two things. One, how can I increase sales unit? How much efforts, how much money I'm spending to increase my sales unit? And second thing, how much it is contributed to my profit. Okay. Am I able to reduce my fixed cost or not? If there is any chance that through which if I can reduce my operating cost, it will increase my operating leverage. Lesser the fixed cost, more will the variable cost, your operating leverage will be very high. Okay. So why companies go for third party third party operation? Because to reduce their fixed cost, to reduce or to increase their operating leverage. Okay. This is what we mean by operating leverage. See, I suggest after you get these slides or after you go for any kind of business, try to find out their sales unit, their sales revenue, their profit, their variable cost, their fixed cost, and ultimately what is their profit. And try to see if you can increase sales by a smaller margin, like 5%, 10%, 7%, how much it is contributed to your profit. Because whatever you are selling above 1,000 units, that completes coming to you as profit. Apart from variable cost, whatever you are making, that completes coming to your profit. Okay. By increasing your sell by 50% from 2,000 to 3,000 units, you have increased just by increasing 50% of your sell, you are able to manage increasing 100% of your profit. Okay. Here I think this is much larger gap. You can see even with the 20 to 100 increase. Okay, you can see or you can calculate in between. Like after this lecture, I will suggest you try to calculate for 20 units or try to calculate for 2400. Okay, 20 to 100 is 100 units is again like let's take example. 20 to 100 unit is increase in 10% of your sale. Okay, your sales revenue will be 2 lakh 20,000. Okay, what will the variable cost? You will increase like 2 lakh is for 2,000 increase. So how much will be the increase in 200 20 to 100? Per unit you are spending 50 rupees. Okay, to 5,000 and 5,000, 10,000 rupees. Right? There will be 2 lakh 10,000 rupees will be your sales revenue. Your variable cost will increase by 50 rupees again. So your profit will increase by almost 25%. Okay. So this is how you calculate for different units and try to see or try to understand or try to apply the logic behind operating leverage. Okay. Don't look at this as just a one concept or just as a one a part of syllabus. Look at this as a application oriented theory. Or can you apply this theory or can you apply this logic in real life scenario? This is what we call by making a small changes, you can increase or your output by multiple times. This is what we call operating leverage. For leverage, in particular leverage, we have seen operating leverage. Now, second part we have is financial leverage. So, in terms of operating leverage, we have seen a competition between fixed cost and variable cost. Okay, but here we are going to see. Obviously, it is again about if you go on if you look at a bird's view, it is again the same thing. We are going to see a difference between fixed cost and variable cost. But in financial leverage, we have two things, that is debt and equity. See, again remember, again as I said, if you look at from a bird's view, they both are same. Fixed cost and variable cost. On other side, debt and equity. Why they are same? Why they are same? Because debt is a fixed capital. Irrespective of whatever business you do, you have to pay interest on that, right? But equity will have your own contribution, that is your own shares. Equity will also have a variable cost. As your profit will increase, your price of share will also increase. Okay, but if there is a loss in a business, obviously you don't have to pay any fixed cost. So that's why actually variable, the equity is your variable cost, whereas debt is your fixed cost. More you save from your own pocket. See, this is also about ownership. The more you save from your own pocket, the less you borrow, more will be your profit. And that percentage will vary from in a similar way. Like you increase your contribution by 10%, but ultimately your profit will increase by 20%. Here we have one example. Apart from this example, I will request you or I will suggest you go for at least 10 examples of financial and operating leverage to understand the utility of this leverage, because this is something which you can use in your real life, okay, in your personal life, irrespective of whether you are going for employment or you are going to be employed, start your business. In both the situation, you have utility of financial and operating leverage. So, what is financial leverage? There is a person, Bob and Jim. They both have started their own business. Bob has invested 50,000 in business, whereas Jim has invested 5 lakh rupees in business. That is completely own fund. There is some business which required 5 lakh rupees, but Jim has all 5 lakh rupees, or Bob has 50,000. This is one example. Here you can always try with a different example. Like there is somebody Kim who has invested 50 lakh rupees from own pocket and 50 lakh rupees from debt. Okay, you can try different case studies. What is the difference between using your own fund and buying or taking loan from other side? See, in between there can be, in real life situation, there can be a third situation. Like you have an option to take either a debt from a bank or you can sell your gold. Okay. Suppose there is some gold and anyhow you are not using it, or even if it is using, you are rarely using it, in a marriage or some functions like this. So you have two options. One option is to either sell that gold and invest that 5 lakh rupees. Suppose your gold is giving you 5 lakh rupees. So invest that 5 lakh rupees into business. Or if you have a 5 lakh gold but you don't want to sell gold, you want to take a debt. So you can also try with that condition. These small conditions, these small experiments will make you expert in financial management. Okay, expert in the sense, obviously you will get a better idea. The more you try, the more you will get. More problems will come to us. This is the situation. If gold prices will also increase, where should I include that? Maybe because we expect some return from gold as well. If I sell today, the price will be different. If I sell after 2 years, price will be different. So even you have to calculate in that okay, how much increment I will get if I sell after 2 years, because I'm going to repay my loan in the next 2 years. So you have to calculate, you have to make a habit of making a balance sheet or writing numbers on paper, because normally we have that habit. We manually calculate in a mental process and we just forget that. We never calculate on paper. So financial management gives you that opportunity to calculate different problems or different equations on paper. And you will come to know what different problems you face, what different conditions can arise, what contingency you have to take consideration. So okay, so let's see this example. Down payment of 50,000 is done by Bob. Jim has contributed complete fund from own pocket, that is 5 lakh rupees. Now it is about debt. Okay, so since Bob has contributed 50,000 from his own pocket and remaining 4 like 50,000 is taken debt from say bank. Okay, but Jim has already contributed 5 lakh from his own pocket, so you don't have to take any debt. Okay, again down payment is your own contribution. You can even consider it as equity. Okay, cost of capital, whatever interest he is paying, like here they are considered 0.5% of interest, 5% of interest. So that is going to 22 lakh, 22,500 rupees. Okay. So ultimately, the sell of house, like they have sold the house for 4 lakh rupees. So a profit after they paid, he is actually in a minus 1 lakh 22,500 rupees. Okay. Actually, you can say like instead of making it a compliment, like consider that he has sold a house for 6 lakh rupees. He has sold house for 6 lakh rupees. So what profit he is making? He is making around 68 lakh rupees profit. No, sorry, 78 lakh rupees profit. Okay. Mota moti, if I sell at 6 lakh rupees, he is making 78 lakh thousand rupees profit. But when Bob sells the house, he will making 1 lakh rupees profit. Okay. So this is called, if you make some changes in a fixed cost or variable cost, your profit will ultimately change. Okay, in this condition, you can see return on investment for Bob is minus 244%, whereas for Jim it is only 20%. Okay, look at the difference between their investment. In their investment, the difference is 10 and 90%. Okay, he has saved, Bob has invested only 10%, whereas Jim has invested 100%. So there is a difference of 90%. But if you look at their return on investment, the difference is huge. It is more than 200%. Difference in investment is only 90%, but their return on investment has a difference of 225%. Right? Again, whenever you're going for financial leverage, you try to introduce or you try to include people based on profit. That is variable cost, not on fixed cost. Let's take an example. Suppose you tomorrow you plan for launching some website or something related with education, and you are bargaining with it. You are in a marketing team. Okay, you are in a bargaining with the marketing team, and they are saying, okay, whatever business we will give you, okay, we will charge 40% of that revenue. This is one condition. But when you sit on your table and you write down your numbers, or you play with numbers, you will realize that minimum 1,000 minimum 5,000 students you need to make your or to achieve your break. Okay, so if you come to know that you need a minimum 5,000 students to achieve your break-even point, and if you're sharing the revenue of that, the revenue even for those 5,000 students, you need around 12,000 students. So you can bargain with those people. Like you can say, okay, let's make a little change in your quotation. I can give you 40% profit, or I can give you 40% of revenue, but after achieving more than 5,000 students. Because after 5,000, see, it's a win-win situation for both the people. Once you achieve a 5,000 student, you will have your break-even point. So you are not in loss. So whatever business you will get after 5,000 students, that is completely profit for you. If you come to that calculation, you can give a little more to them because your risk is reduced. Because if you get customer less than 5,000, then you are in loss. And even on top of that, if you have to sell 40% of revenue to marketing team, then again you will be in a big loss. Okay, so you have to calculate the situation on numbers, and you have to see what is the financial risk, how to communicate with the people. Okay, how to bargain, and you can bargain only and only when you have numbers ready. Yeah, this is what we have to learn from financial management. to write down the numbers, to understand the calculation and make different conditions to bargain with the customer. I'm sure if you go for a bargaining, 90% of the time, you will see the person to whom you are communicate, they are not, prepared their financial management. But since you have learned the financial management and you are serious candidate, you will do different calculation to understand what is your minimum condition or what is your maximum limit. Okay, if something is, something is lying in that particular line, then obviously you can go for a better bargain. Rather than going blindly, you can go with a planning part by making different statements, by understanding different conditions, by considering different situations. You can make your statement, and you can see the moment you will place a situation, you can understand what will be my profit and what will be my loss. So there will be easy calculation, mental calculation, or you can have your notebook with you. There is not an issue. So there will be an effective bargaining, or there is a high chances that the bargaining will ultimately land in your area or your court. I don't know those who are not from financial background how much they are able to understand the utility of financial leverage and operating. But don't worry, just try different cases, create your own case, and try to see how much difference they are making once you make a calculation and before you make calculation. If you see that yes, making a calculation or making a different case studies helping you to understand the utility of financial operating leverage and you can apply those things in your real life, then this is the best way to learn anything. If you know implementation of the particular concept, this is the best one. Okay. So as I said, there are different thinkers who have given different theories. Like there is a bottom of pyramid theory by C.K. Management. He has given a study where he has said, you can start a business, you can sell to a mass people, and you can still make a profit, and you can improve the standard of living of people. This is a win-win situation for everybody. It is not about selling product at a high prices and making a lot of profit and selling it to few customers. Like there are different people. Like Yamaha. Yamaha has a niche customer base. They don't look at the average because their bike give average of 35 to 40 mileage. But if you look at other bikes like Yamaha, like Hero and Bajaj, they work on high mileage, and most of the people look for mileage. Okay, that's why they have a huge customer base compared to Yamaha. So there are different business strategies by different companies, but you have to consider about the financial leverage by increasing like many companies have realized that this is somehow you have to work in India, you have to work for mileage. So many companies like even Yamaha had launched many bikes which are claiming for more than 50 average or 60 average. Why? Because they have realized if we increase our sale by 10-20% by attracting those customers who are looking for a mileage. Ultimately, see, anyhow, I am having those customers who are looking for a style or comfort or engine. But there are few people who are able to attract them who are looking for a mileage, maybe at 10%, 20%. My ultimate profit will go up to 40 or 50%. This is what we call the leverage. So you have to calculate how you can increase your sales, how much cost you are paying to increase that sales, and ultimately how much profit you are getting as a recent case study of Baiju. Baiju 2018 statement, I was reading their statement 2 days back for some other one. So Baiju has increased, there in 2018, their expenditure on advertisement was 188.5 crore. Okay. Maybe you will think that it is a very high expense. Yes, it is very high expense. They have a short of fund. Okay. So 188.5 crore is their expense on advertisement. They are available on everything. They are available on YouTube. They are available on Facebook. They are available on television. They are available on best of the best serials, programs, cricket team, IPL. They are available everywhere. But if you look at 2016, they have realized a loss, a net loss. After spending around 70 to 80 crore rupees on advertisement, they have realized actually loss. But by increasing their expenses, like their previous expense was actually 150 crore or something, 2017. So by increasing their expenses by 20%, their sale has gone 100%. Like from 260 or 270 crore, they have gone up to a 460 crore of revenue. So by increasing 20% of their expenditure on advertisement, their revenue has gone to 100%. Okay, this is how you have to use a financial leverage. Okay, we will see again one more thing, that is cost benefit analysis or performance index. This is quite similar. Okay, but I hope you have understood. We have spent little more time on financial operating leverage because I understand this is something which has a lot of utility. Whatever we are going to study today, this has a lot of utility in your real life. Okay, even like this is something apart from a financial management example. By compromising some ego or some of your demands in the family, maybe ultimately you can have a long term profit. So it is always recommended to sacrifice some of the your demands or ego to have a larger profit. This is also leverage. So you have to see how much sacrifice I'm doing and how much ultimate benefit I'm getting. If benefits are more than what I'm sacrificing, then obviously it is a accepted business or it is something which you should accept. So this is also a leverage. Okay, so we have discussed financial leverage, operating leverage in detail. Practice a lot of examples. Create your own examples. Even you can take these examples and you can try something in between. Like Bob has invested say 1 lakh rupees and taken a 4 lakh rupees loan. Jim has invested 2 lakh rupees and he has taken a loan of remaining 3 lakh rupees. So calculate the differences and calculate various profit and what is percentage difference in increment in down payment and increment in the profit. You will see there are a lot of differences which makes like it is not a similar calculation that increase in 20% increment will increase 20% profit. No, increase in 20% investment may lead to increase in 50% of your profit. So this is what you have to understand from the core of your core of the concept, as well as you have to understand the application and you have to apply in your own life wherever you can. Okay. Next part is capital budgeting. Capital budgeting is like when you see government budget, every year government launches their budget in the month of last week of February or first week of March. You can say they use this word budgeting, capital budget, okay, revenue budgeting, capital expenditure, revenue expenditure. They use lot of terms related with the finance management. Now going ahead, you will understand that budget. Maybe we can take some other session on budget, complete budget, how to understand budget. But right now we don't have that liberty or we don't have that leverage to spend that time. But okay, we'll see if we get a time or we get one different like separate lecture, we'll understand what is the budget and how to understand Indian government's budget and what is the utility of understanding their budget as a business person or as a citizen of a nation. Okay, so capital budgeting is whatever investment you are putting or whatever investment you are doing for your business for a long term. That is capital budgeting. Okay, long term that again defines maybe 1 year, 2 year, whatever time you spend. That is capital budgeting. How much investment you are planning in long term asset is your capital budgeting. Why capital budgeting and why not revenue budgeting? Because on day-to-day basis, whatever you spend, that may not have implication of long term. But whatever you spend on capital budgeting, that have implication on long term. Suppose you bought a machine, and that machine is not only saving your manpower, like instead of 4 people now you need only manpower, but it also has a capacity of producing more number of items that even four people used to produce. And over and above them, they may have a better quality, and you are not dependent on people. So there are a lot of advantages. I'm not going into that socialist perspective that machines have led to loss of jobs. But here, from a perspective of entrepreneur, from a business perspective, definitely it is accepted a proposal. So capital budgeting is about, it refers to long-term planning for proposed capital outlays or expenditure for the purpose of maximum return on investment. Okay, since you are investing in a find up on a machine whereas you are paying only 10,000 rupees to per employee, so that is 40,000 rupees. But ultimately, when you spend a few months, like maybe 13, 14 months with the same people, where you are not paying any salary to the machine, but you will be able to recover the cost of the machine by making a profit, as well as you are able to use that same machine for next 2 years. So this is obviously capital budgeting. Maybe you are investing higher amount compared to what you have to spend on a day-to-day basis. Like for portfolio, you are paying only 40,000 rupees, but you are spending 5 lakh rupees to buy that machine. But after 12, 13 months, that machine will be free to you, or you will achieve the break-even point where your profit and loss will be zero. But after that, you will make a profit. Okay. So by looking at a long-term perspective, you are investing something that is called capital budgeting. Okay. So why we have to think about a capital budgeting or why we have to make a in long-term perspective. First is long-term goal. Obviously, if you are looking for business for that particular month only, then it is better to pay for that 4 people because you are able to do your work in that particular month. But if you are looking for a long-term perspective, then obviously you have to buy that machine. Like we have discussed recently about if you are starting your business, education business, and you want some software and it is costing 10 lakh rupees. There are two options. One is either you can buy the 10 lakh rupees of machines because you are looking for a long-term perspective. But if you are not sure about your business and it is just a startup, and you don't want to take a risk of that 10 lakh rupees or you don't want to invest that 10 lakh rupees as a fixed cost because that is going to reduce your operating expense, then you can go for a third party. That is 40,000 rupees. Maybe you are spending 40,000 rupees a month, but your risk is not about 10 lakh rupees. Now your risk is only about this 40,000 rupees. Okay. So long-term importance of capital budgeting is if we give you long-term goal. Okay. If you have a long-term planning, then obviously it is going to give you better returns. Okay. This is one of the importance of capital budgeting. Involvement of large amount of funds. Obviously, since you are investing a lot of funds into buying machines, equipment, or investment of machines, or buying assets, then obviously you have to make a planning because you are going to invest a lot of amount. So how you can ensure you will be in a better condition, or you will be have in a better control of investment only and only when you have capital. How much I'm spending, how much return I'm going to get in a coming year, on how long it will take me to recover the cost of machines or cost of assets or cost of investment. That's why you need to make a capital budget because it's a large amount. Irreversible decision. Obviously, in most of the cases, once you invest in capital budgeting, it is very difficult to recover money from that until and unless you do a business. Like I said, if you buy a software over 10,000 rupees, and tomorrow you have decided, or tomorrow you are not able to make a business, or tomorrow you are not able to do a business which you have expected, sorry, then obviously it is difficult to sell that software at 10 lakh rupees. Maybe you will face huge loss, or you will not be able to sell that products. That can be a condition. Like there is another example. I have seen that example. A person bought a land to start a poultry farm. They constructed a complete infrastructure for that. That they spent 40 to 15 lakh rupees for completing that infrastructure. But ultimately, that person got a job in some other country, and he has decided to move to that country. And ultimately, that complete land and that complete infrastructure went into a drain. They will not able to take it. The land is still there, but that entire infrastructure is waste. That infrastructure itself is cost 20 plus lakh rupees. So that's why you have to make a capital budgeting initially to understand whether investing in this proposal is worth or not. Okay, that's why, and that you can do through capital budgeting. Okay. Monitoring and controlling the expenditure. Obviously, since you have a planning, you have made a planning in advance, you will always able to understand where I'm standing now. If it is moving as per plan, it's okay. If it's not moving as per the plan, you can take a corrective action. That is what we call control. So that's why whenever you are going to invest a huge amount, you have to make a capital budget because you are always in a condition to monitor and control if it is not moving as per a desired way or desired planning. Transfer of information. Obviously, since you have made a capital budgeting, you know how much money you require. Suppose you have bought something on EMI, or you have to pay in an annuity. Okay. So you can share a similar information with your sources from where you are going to get the money. Okay. You can share with the information that I need X amount at particular day, then X amount at another day. So definitely there will be transparency. It's not only you, but other people will also come to know how much money you need and when you need this money. So this is about a transfer of information from different stakeholders. Difficulties of this investment decisions. Obviously, since it is a huge investment, you will have a different options. You have alternatives. So since there are many alternatives, you have made a capital budgeting. You have started making capital budgeting for different alternatives. Ultimately, you can easily calculate which one is a more profitable. Maximization of wealth. Obviously, there will be less loss. There will be more profit, and ultimately, the finance manager's ultimate aim is to maximize the profit of a stakeholders or maximize the wealth of a stakeholder. So since you are making a capital budgeting, you will be able to achieve that condition where you will have a maximum wealth for your own This is about importance of capital budgeting. Capital budgeting, I will again revise what is capital budgeting. Capital budgeting is about whenever you have to invest for a long term, in assets, you have to make a capital budgeting. Making a capital budgeting means what? How much you are investing, how much return you are going to get, period of over a period of time. So you calculate everything and you ultimately realize whether it is worth investing in those assets or not. Whether the inflow of cash is more than outflow of cash is or not. If it is not, then you cannot go for it. So, okay, if inflow is more than outflow, then obviously you will accept this. So this is about capital budgeting. Okay, like you are buying a flat and you have to pay EMI 25,000. Say, consider you have to pay EMI 25,000, and if you give this flat on a rent, you will going to get another 25,000. Like you are going to get 25,000. So you can directly transfer your rent. This flat is accepted or this proposal is accepted. But suppose you are investing, say higher amount on that, and your EMI is 25,000 rupees, but the rent which you are going to get is only 10,000. Second thing, you will calculate that there is downfall in real estate, so you don't expect much increment in a price. Third thing, the EMI which you are going to pay is very high, and the interest part on that particular part is also high. So in this condition, obviously you will reject it. So based on capital budgeting, based on outflow and inflow of money, you take a decision whether you want to go for long-term investment or not. Okay, whether the particular investment gives you liquidity or not. Okay, can it going to help you to improve your business or not? There are types of capital budgeting which we have to see what capital budgeting means or what kind of types we have in a capital budgeting. There are two kinds of capital budgeting. Capital budget increase revenue. Okay, if you invest or if you buy suppose a machine. Okay, today you are making 10 packets a day. If you buy or if you invest in a machinery, you will be able to make 50 pockets a day. Okay, 50 packets a day, suppose a food item. Obviously, since you are making 50 packets a day, it is going to increase your revenue, and there is a market for 50 packets. Okay, so obviously you will invest in those areas where it will increase your revenue. Okay, second kind of expenditure, second kind of capital budgeting will be such where you actually reduce the cost. Okay, since you are going to today you are making a 10 packets a day, and you are incurring a 10 rupees cost. Okay, on manufacturing part. But if you buy a particular machine, that will reduce your cost by 50%. Okay, then it's a machine. You can do a much faster work. You are not dependent on employees. Okay, and you can even work on Saturday and Sunday. Consider. Okay, so hypothetical example. That is actually reducing your cost. That particular machine will not lead to increase in revenue, but that will reduce your cost. And we have seen there are three ways of making a profit, or there is three ways of making efficiency, ensuring efficiency. One is increase your input and increase your output. Increase your input and increase your output. Second is keep a same input, okay, but increase your output. Or third condition will be decrease your input, but keep outputs on a similar line or the same line. So there are three ways of increasing your profit. So if you look at in the same context, you will realize either you can make a profit by increasing revenue, like increase your input by investing into capital budgeting, and increase your revenue, that is increasing your profit. Or second way, reduce your expenditure. Reduce your expenditure in the sense, reduce your input. Okay, reduce your input, but increase your output or keep outputs on the same line. Okay, since your cost is decreased, but your profit will be same. That is also about efficiency. So capital budgeting in a two-way leads to ensuring efficiency in your business. One, by increasing your sale or increasing your revenue, or by reducing the cost of your input. Okay, either you can increase your output or you can reduce your input. Take an example, farmers who said, like recently Nitya said, there are two ways we can increase productivity or efficiency. See, this is the same model which everyone uses. Okay, they just give a different name to it. Nitya said, there are two ways through which we can save our farmers. First, make sure they get a better technology, they get a better seed, they get a better fertilizer, and they will have a giving subsidy on urea, providing or keeping a mark, okay, or keeping a limit on selling price of seeds, selling price of fertilizer, selling price of pesticides. Okay, so both if you look at if you look at from both, you will see it's the same thing which we are discussing about capital budgeting, or which we have already discussed about 3 ways of increasing efficiency. Okay, they both are same, just they have used that concept in a real time, in a real life, in a real scenario. Okay, and this is what we also have to understand. See, by doing the MBA, it's not that something you should understand some definitions, or you should understand some types or concepts. It is about how much you can understand and how much you can apply it to a real life. Okay, if you're able to solve a lot of case studies, if you understand market, if you read some business standard newspaper, and if you see, no, this is the concept which already discussed in this chapter. If you are able to connect your syllabus, or that is content, and the reality, then obviously you will be in a better place than others who are doing it. Because most of the time what we do, we understand this as a curriculum, or we take MBA as another course where we have to pass. It is not about passing. If just passing a MBA will not give you that excel. If you want to excel, then obviously you have to understand applying different concepts, different theories in real life. Because these theories, this content part is created after so much of research. If you are not understanding the mechanism behind that concept, then you will not be able to apply those concepts in real life. If you are not able to apply the real life, it will become just a concept, and trust me, after 6 months or after 1 year, you will forget that term, or you will just forget what is capital budgeting. Okay, because the word itself is not suggesting something like capital budgeting, you will not understand. Okay, another example, take other example. Like there are two friends, Ramesh and Suresh. Okay, they both have a 50,000 salary. They both have a 50,000 salary. One day they sat, maybe 25th or 26th of a month they sat, and they said, "What you have done with 50,000 rupees?" I spent all. Both have answered that I have spent all 50,000 rupees. I don't have a single penny now. Okay, so maybe somebody asked them, okay, where you spend it? I bought a cloth, I bought shoes, I bought, say, travel or something like that. Okay, Ramesh has answered all the things. Like I spent for my luxurious life. Second person, Suresh, they have asked, what you have done with that 50,000 rupees? I bought a gold. I spent it to buy a gold. Both are expenditure. Both of them don't have a single penny in their account. But there is difference between spending on clothes, and there is difference between spending on gold. Why? Because one is capital expenditure and one is revenue expenditure. What we mean by capital expenditure and revenue expenditure? See, revenue expenditure doesn't have any implication on saving money. Okay, once you have paid the salary, it's paid. You are not going to get out of anything from that salary. Once you paid the rent, you paid the rent. You are not going to get anything in next month. Okay, but if you are investing in capital revenue, capital budgeting, then obviously you can, like, you have bought a gold. Definitely today it's expense for you, but if tomorrow you need a money, then obviously you can sell that gold. But can you sell the cloth or oven or shoes? You can't. So there is a difference between the expenditure as well. So being a student of MBA, you have to understand, if I'm investing money or if I'm spending money, where I'm spending money. If you join some classes, that is a capital expenditure. That is not a revenue expenditure. You are going to get a lot of things from that course. Maybe you can make a money from that course itself. Okay, but revenue expenditure is like spending money for enjoyment, for watching movie. I'm not saying entertainment is not essential. That is also essential. But you have to calculate how much money or how much part of your salary you are spending on capital revenue, capital expenditure, and how much you are spending on revenue expenditure. Okay, if you are able to make that calculation, or if you are able to use a financial management concept in real life, trust me, that will be more enjoyable. It's not only about your saving, or your saving will increase, or your profit will increase, your betterment will increase, but also that will give a satisfaction. There is something called living a life or living conscious life. Okay, what is the difference between well-educated person? They live a conscious life. They know where they are heading. Okay, they know what they are doing or how much they have to do. Okay, but somebody who is working for a money, they work for entire day and they don't know where they are going to spend that money. But those who are living a conscious life, they know to live a decent life. I need this much money. If I get this much money, I will spend this much money on this thing or this much money on this thing, and this is my requirement. So I don't have to work more than this limit to earn this money. To make that particular money, I just have to work for 6 hours, 10 hours. That's it. I will work for that, and every time I will spend in other quality works. But those who are not living conscious life, or those who are not using a conceptual part in their life, they will work for 17 hours, 18 hours, or whatever hours they can work, because they think the more the money, more the enjoyment. It's not that. Okay, I remember like John Abram, he is MBA from Sydenham College, a very reputed college. He has said it is more important to understand how to save for money than how to earn the money. Because if you don't know how to save the money or how to invest the money, then whatever amount you are earning, that will not be a very fruitful, because there is always limitation on how much money you can earn, but there is unlimited options you have to save or invest your money, right? So this is what we are going to learn from financial management as a subject. I know there is lot of technicality, lot of people are facing difficulty in understanding the basic terms, but don't worry. Use your own notes, like whatever notes our institute has provided. Use those notes, or for understanding concept, I'm giving you easy examples or cases, different cases. You can read those concepts, and whatever, maybe if you understand even a 50, 40% from the books, from the lecture, it is enough. But make sure you are able to use that 40%, 50% of your understanding in your real life. It is useless if you are understanding 100%, and you are applying 0% in your life, right? So there are some techniques about capital budgeting, a traditional model, traditional approach. Like whenever you invest something in traditional, suppose take example of our dadas or dad, okay, grandfather and grandmother. What they used to do whenever they used to buy some asset or some land or whatever they used to buy, they had some traditional method, payback period. Okay, if I invest 1 lakh rupees into buying a particular machine, how much time it will take me to earn back 1 lakh rupees to achieve that break-even point? This is the traditional method. If you're taking 2 years, I will not go for it. If it is taking 1.5 years, I will go for this option. Okay, so depend on your payback period, like payback, how much time it will take to bring your own money back in your own pocket. That is payback period. Okay, if it is shorter, you will choose that. If it is longer, you will not choose. Average rate of return, how much return you are getting every month or every year, whatever you have taken as a parameter. So this is a traditional approach. Either how much time it is taking to bring my money back. Second thing is how much money I'm going to make after every interval, maybe after a year or after a month. So this is a traditional method. Based on these two traditional methods, you decide your capital budgeting. Modern methods. Now this is something which is context now. This is first is net present value. So if I'm going to get suppose 5 lakh rupees after 5 years, but what is a net present value of that money? Okay, based on present value of money we have discussed yesterday. What is the present value of that money? If I'm going to get 5 lakh rupees after the 5 years, and today I'm going to invest 2 lakh rupees, so what is the value of that 5 lakh rupees? If it is again a same value, then it is worthless to invest in that particular. Or it is even if I'm getting a 2,50,000, but even if I save in some other prospect, I'm going to get a more interest today. So then obviously that particular method of calculating net present value, that formula will give me, okay, that give me a perspective about whether I will go for option A or option B. Internal rate of return, obviously internal rate of return is how much inflow and outflow is there between that cash flow, whether I'm able to get my money back whenever I need, inflow is more or not, or outflow is less or not. Modified internet rate of return, obviously similar to this thing, but there are not only qualitative and quantitative analysis, but we are also including qualitative parameters. Okay, and the finally is a profitability index. So what is a profitability index? Profitability index is about cost benefit ratio. Okay, input output ratio. How much input I am getting or output I'm receiving. Like take example, like here I have given a financial example. You can study about the financial example. Like if I introduce a cash flow, this rate discounted cash flow, what I'm getting is like after investing 10,000 rupees, here I have invested in a 0 year, I have invested 10,000 rupees, and ultimately after 5 years, I am to get 12,555 rupees. That is almost a 20% increment, a 20.5% increment. Okay, so I have calculated net present value of whatever I'm investing in this year will be 12 lakh 55 20%, 20.5% of increment value. So obviously, normally what we expect is a investment of or earning of 3 to 4% a month or 24% a year. So definitely what I'm getting is equal to that. 24% of return is accepted. Okay. So this is something which is a profitability index. Okay. How much I'm investing and how much I'm getting. So this is based on capital. They have calculated net present value. They have used here a net present value method to understand whether should I go for capital budgeting or not. Suppose you have a two books to read. Okay, you have a two books to read, like using the profitability index concept in your own life. Okay, suppose you have two books. You have noticed that if you read book one, there is 80% of questions that are coming from book A, but it is very bulky. It is very bulky itself. It is taking me 10 days to finish the book. Okay, but I have seen other book which is half of the book A, but 60% of the questions are coming from this book. Okay, so you have to calculate cost benefit ratio. Okay, I am investing 10 days to get 80 marks, but I am investing only 5 days to get 60 marks. So definitely I will go for two books which are similar to the second book, because here I'm getting a 60%. Maybe if I read other book, I may get I may invest other 5 days, but my percentage will be 90%. So how much time I'm giving and how much return I'm getting, this is a profitability index. So before making a capital budgeting, you have to ensure okay, how much money you are spending and how much benefits you are getting from that investment. So this is about profitability index. This is also real life situation, cost benefit ratio. How much benefit you are getting, how much investment you are doing, or how much cost you are paying for that. Okay, this is all from fourth unit. Next unit we will start next Saturday working capital, and after that next Sunday we'll start some other subject, maybe accounting management